Hello and welcome to Chapter 21 in Healthcare Supervision. We'll be covering budgeting and cost control. Now, in my experience as a manager, this was probably one of the things I like the most, and not necessarily just because I like numbers and I like spending money, but just because it was always a challenge. Having a department budget and knowing how much money you have to spend each month and trying to come in either at that amount or below that amount was just always kind of exhilarating to me for some reason. So anyway, we're going to start on page 351. We're going to go past the for consideration and start in the section labeled Introducing the Budget. So there are likely to be considerable differences in the ways different supervisors approach this chapter. In some institutions, individual supervisors have been actively involved in the budgeting process for years. In other institutions, however, the budget remains a mysterious collection of numbers assembled by higher management and finance without supervisory involvement. So jumping over to that next column. This chapter provides an overview of the budget and the budgeting process, offers some specifics for consideration by supervisors who do not have backgrounds in accounting and finance, and provides the individual supervisor with guidance for controlling the department's cost on an ongoing basis. A budget is a financial plan that serves as an estimate of future operations and, to some extent, as a means of control over those operations. It is a quantitative expression of the institution's expressed operating intentions, and it translates these intentions into numbers. So in participative budgeting, some organizations, the budget is still prepared upstairs, in quotes, and handed down for supervisors and department heads to live with. This practice leaves a great deal to be desired because it requires the supervisor to implement a plan without having participated in the plan's development. Fortunately, more and more healthcare institutions are bringing their supervisors into the budgeting process. The team approach to budgeting, requiring active participation of managers at all levels, calls for close coordination of a multitude of diverse inputs and activities. It takes considerably more time and effort to assemble a budget in this manner than it does to simply allow administration and finance to get their heads together and issue a budget, but the results of the team approach are well worth the extra work. The participative approach to budgeting has several distinct advantages. The end item of the process, which is the budget, is usually a far more realistic and workable plan than any that could be developed by some other means. You know what your department needs. You know the equipment you need. You know the supplies you need. You know any kind of maintenance that you have to purchase on an annual basis. Next, the involvement of individual supervisors in the process breeds their commitment. They're more likely to believe in the budget and strive to make it work because they took part in its development. Can't even tell you how I would feel if somebody said, okay, this is how much money you have to spend, if it was unrealistic. Now, when I'm a part of it and I know what my department needs, I know what my staff needs, and I make a realistic budget, then yes, I am much more likely to make that budget work. I don't know about you, but if somebody handed me a budget and said, here you go, and it was unrealistic, I'd probably go a little nuts and maybe overspend just to prove my point. Now, whether that's right or wrong, who knows? But, all right, third option here. The interdepartmental and intra-departmental activities and interpersonal contacts pursued during this process tends to strengthen supervisors in their jobs. So you do have to work with other departments. For example, HIM is closely related to IT because of different software. So who's going to take over maintenance for these different software systems? So you kind of work together to ensure that all things are covered. And then fourth, a spirit and attitude of teamwork is created in getting managers at all levels to work together toward a common goal. Teamwork is, to a great extent, one of the keys to successful operation of an organization, and we all know about that. And lastly, the encouragement of more realistic planning serves to sharpen the focus of management's efforts and produce more appropriate results a greater part of the time. So, involving the individual supervisor in the creation of the budget helps define clearly the authority you possess and the responsibility you're charged with in the operation of your department. Quite simply, you created your budget, so you're responsible for operating according to that budget. All right, so let's move over to the accounting concepts on 352. Before discussing how a budget is structured, explanations of a pair of simple but important concepts are in order: the fiscal year and the fixed versus the flexible budgets. So the fiscal year is simply your institution's 12-month accounting year. This may be any consecutive 12-month period established for accounting purposes. For instance, May 1 of this year through April 30th of next year, that could be your fiscal year. North Mississippi Health Services, their fiscal year begins on October 1 and ends on September 30th of the prior year. The state of Mississippi, their budget or their fiscal year starts on July 1st and ends on June 30th. So different companies, different facilities have different fiscal years. It does say that the government of several states have encouraged their healthcare institutions to use the calendar year as their fiscal year if they're not already doing so. So your fiscal year could coincide with the calendar year, January 1 through December 31st. So within the accounting year are a number of accounting periods. It is common practice to keep track of payroll and certain other expenses on a basis of 1, 2, or 4 weeks, and to accumulate this information on the basis of the 4-week accounting period. Thus, there are 13 such accounting periods in the year. However, other important facts and figures are accumulated by month, either because it is necessary to do so or because this is clearly the best data collection period available. Accountants and others speak of month close or month end, which is the act of determining the financial results of operations for a given month. Now, moving over to 353, that last paragraph in that same section. The idea of fixed versus flexible budgeting refers to the structural character of the budget relative to activity throughout the year. A fixed budget assumes a stable level of operations throughout the year and spreads all budgeted costs evenly over the 12 months. A flexible budget, however, recognizes that certain costs can vary as the level of operations varies and attempts to account for this variation in the budget. A flexible budget may treat certain costs as fixed because they are in fact fixed, or because this is simply the best way to handle them, but it will also identify and allow for costs that vary as departmental activities vary. So fixed budget is going to basically take the entire budget for the year and then apply that evenly over the 12 months. Your flexible budget's going to, still have some fixed cost, but it does understand that, like, let's use our 3M maintenance. So we use the 3M encoder in the HIM department, and there's a yearly maintenance fee required for that. Well, that maintenance fee is only paid one time of year. So that month is going to be where I budget that cost. I'm not spreading it out over the 12 months. I'm budgeting it for 1 month. And that cost could be as high as $260,000 or $300,000, just depends. So that's where your flexible versus fixed comes in. All right, so let's talk about the total budget. There are several parts to the institution's overall budget, some calling for the supervisor's involvement and some that with the supervisor will rarely be concerned with. The parts and subparts of the total budget described in the following paragraphs are each properly identified as budgets in their own right. So if it seems as though we're saying a budget is a part of a budget, we're doing so in the sense that with these financial plans, I can't even talk today. Okay, so let's start over. A budget is a part of a budget. We're doing so in the sense in which these financial plans have always been described. So let's start with the operating budget. And we've got 3 budgets underneath that. So the operating budget has 3 parts. First is the statistical budget. This is made up of projections of activity for the coming budget year. usually based on a combination of past activity, current trends, and some limited knowledge of future conditions and circumstances. This is the organization's best estimate of work activity for the coming 12-month period. These estimates are projections of statistics such as admissions or discharges expected, patient days expected, likely number of laboratory tests or x-ray procedures, number of meals to be served, pounds of linen to be processed, and so on. Dropping down to our next budget, the expense budget. The expense budget anticipates cost of operations for each department individually and for the organization as a whole. In a true participative budgeting process, the departmental expense budget is the primary area of supervisory involvement in the budgeting process. The expense budget is made up of projections of personnel cost and all other cost. The cost of anything acquired or consumed in the operation of the department and directly attributable to the department will ordinarily appear in the department's budget. All right, and our last one, the revenue budget. Usually prepared by the finance department, the revenue budget is a projection of the likely income to be received by the institution during the budgeted year. Keeping in mind that revenue ultimately must cover all cost of operation, the revenue budget must attempt to consider the impact of numerous factors beyond the simple earning of income of services. A revenue budget may, for instance, reflect the impact of a new service coming into being during the budget year. So if you just add a whole new service, I'll use the example of pediatric intensive care. North Mississippi Health Services added that just last year. They have a 4-bed PICU now. So that is a new service. Then you could have the effects of services being deleted or curtailed during the year. Another example of that is they closed their SNF unit. So they no longer have SNF beds. And they also closed, I think it was 7 or 8 beds at the behavioral health unit. And they only staff 30 beds now. Or additions to or departures from the medical staff that have a direct bearing on number of admissions. If you have a very high-profile cardiothoracic surgeon that leaves your facility, that's going to have an impact on the number of admissions and the number of surgeries that you have. And last, the effects of changes in reimbursement regulations introduced by major third-party payers. Who all knows about all the issues that North Mississippi Health Services has had with United Healthcare and Blue Cross Blue Shield? So those are just some examples about how, payers change. I think North Mississippi Medical Center had lost over $12 million in one fiscal year due to Blue Cross changes. All right, moving on to the next section. We're talking about the capital budget now. So a capital budget is prepared to account for potential expenditures for major fixed and movable equipment. Fixed equipment is going to be your buildings, a new boiler or a new roof, and your major movable equipment is going to be your copy machines, your hospital beds, x-ray machines, computers, and so on. They represent the costs that must be capitalized. These costs apply to operations for considerably longer than just the coming budget period, so they must be spread out over a number of periods. Sometimes the boundary between capital purchases and items that can be allocated to operations in the budget period is hazy. However, consistent with legal guidelines for determining what must be capitalized, the institution usually has its own guides for determining what should be called a capital purchase. Now, moving over to 335. Capital budget requests usually receive close scrutiny, and the request for a substantial capital expenditure must be usually accompanied by the following: a realistic assessment of the urgency of the priority of the purchase. So, an expression of priority. Next, a detailed projection of all costs involved. A full description of the project and the rationale or your justification. A statement as to whether the requested item represents an addition, replacement, or an improvement. And last, the impact, in the case of a revenue-producing department, of the proposed acquisition on revenue. Most capital budget requests are subject to several levels of review and approval. As a supervisor, you may have to be assigned a certain dollar limit for capital purchase for your department, but this amount will usually be low when reckoned against the cost of desired capital purchases. However, it's just as likely, perhaps even more so, that you will personally have no capital budget approval in your department, and I can attest that that is the case. If an item was considered capital, you have no control over that whatsoever. At North Mississippi Medical Center, a capital item was something over $5,000. So if we were going to budget for a new copying machine and it was only $3,000, then that was not considered a capital item. But if we wanted to have renovations done to our release of information area to better help people with disabilities, people that come in with wheelchairs, so that they can have privacy when they come in to get copies of their medical records, that's a capital expenditure, because that's going to be anywhere from $30,000 to $50,000 in renovation. So your immediate supervisor, or perhaps the chief executive officer or finance director, may retain the authority to approve minimum capital purchases up to a given amount. Many capital expenditures, however, must be authorized by the board of directors. So one particular hospital, an acute care institution of approximately 200 beds, permits its CEO or finance director to approve capital expenses not exceeding $2,500. So anything up to $2,500, the CEO or finance director can just approve themselves. Purchases from $2,500 to $10,000 may be approved by the finance committee of the board of directors. And then anything exceeding $10,000 has to have full approval by the board. And each one of those is different. So like I said, North Mississippi Medical Center was over $5,000 that was considered capital. All right, so let's talk about the cash budget, moving over to that next column. Cash budget is prepared by the finance department and is usually done last in the budgeting process. It consists of estimates of the institution's cash needs as compared with projections of cash receipts over the time period covered by the budget. The pattern of cash in versus cash out examined in the cash budget is extremely important to the institution because of the need to remain financially solvent in the short run. The cash budget holds clear implications for everyone concerned with the management of receivables and payables. Should cash be in extremely short supply for a given period, we may turn more attention to aggressive collection of accounts receivable, or we might delay a few payables until we're in a better position to make payment. A lack of cash can also lead to short-term borrowing. This sometimes results in not inconsiderable difficulties in obtaining credit and leads to still more operating expenses because of interest rates. Any organization's cash position at any given time is critical. Cash is a key factor in ensuring an organization's continued financial health. So this slide says that cash is king, and if I heard the CFO of North Mississippi Health Services say that one time, I heard her say it 1,000 times. That truly was her motto that she lived by. Cash is king. All right, so at the bottom of that page on 335, 355, the last little sentence down there, a business can survive indefinitely if it never runs out of cash. But without cash, it can remain open only weeks or months, regardless of how much it might be worth on paper. You think about what cash is used for. That pays your bills. That pays your electricity bills, your water bills, your supply cost. So if you run out of money to purchase that stuff, you're not going to stay open very long. But you may be worth millions and millions and millions of dollars. But if it's not liquid cash, you can't continue to operate. All right, so let's go over to 356 and the last sentence under that same section. To be kept under control, cash must be monitored and actively managed on a continuing basis. In the final analysis, cash is the critical asset the organization must have to remain in business. All right, and this slide says, always remember, a budget is a plan that attempts to look into a time period in the future and is necessarily based on projections and estimates. So just remember, budgets are estimates. All right, so moving over under, this is not part of the slides, but I wanted to cover it in the chapter, but under that section called the departmental budget, going down to that operating budget, at the top of 356, the individual department may be required to supply activity information for the organization's statistical budget. In many departments, there is a direct relationship between expenses and activity. For example, lab and diagnostic imaging will develop projections of expected volume that will be used at both organizational and department levels in assembling estimates of likely activity for the coming budget period. The expense budget is the principal part of the department's total budget. This includes the estimated cost of personnel, which is going to be your salaries and pay increases if you're going to give pay increases, and benefits. Although these are often budgeted by human resources or finance for the organization as a whole. So they've always said that your employee benefits is about 30% of your employee's salary. So if a person makes $30,000, then a little less than $10,000 has to be budgeted for benefits. So that's something to consider when you're budgeting as well. Not just their salary, but what you're going to pay them in benefits, whether that's retirement compensation or their health insurance, etc. All right, dropping down. So outside of the salaries, it's also going to include supplies, fixed expenses, equipment repairs if applicable, and staff education. And then the majority of departments will have little to do with the revenue budget. They are, however, some revenue producing departments, like your food court, your parking garage if they charge for parking, child care centers. These departments will ordinarily supply their forecast of revenue producing volume to finance, where they are expressed in dollar terms and folded into a total estimated revenue. All right, so let's go over to staffing and scheduling considerations on 357. So let's look at these definitions here. In practice, the terms staffing and scheduling are sometimes used together to refer to a general process. Often they're used separately to mean essentially the same thing. Although they are as closely related as the two sides of a coin, there are practical differences. So staffing is determining how many people of what specific skills are needed and making them available. Scheduling is determining who, by name and skill, will do what work and when for a specific time period. So as they relate to the basic management functions, staffing is largely a part of organizing, while scheduling is essentially a refined component of planning. Just as a budget is a quantitative plan for the future time period, a schedule is a quantitative plan for a coming period of time. All right, so let's talk about full-time equivalents, or an FTE. The term full-time equivalent simply means the amount of labor input equivalent to one full-time employee. Assume, for example, that the basic work week in your organization is 40 hours. In your department, 40 hours of personnel time constitutes one FTE. These 40 hours may belong to a single scheduled employee who works 40 hours a week, or it could be broken down into two part-time employees who each work 20 hours a week, or some other combination of hours and people that adds up to 40 hours a week. So all of these variations represent one FTE. So we're talking, if your work week is 40 hours, then I could have one full-time person that works 36 hours. Let's say they're considered full-time at 36 hours, and I hire a part-time person that comes in 4 hours a week. That's considered one FTE. 36 plus 4 equals 40. So staffing calculations ordinarily begin with the determination of how many FTEs are required to cover a particular activity. Later, scheduling will determine how many people working, how many hours are needed to provide this coverage. So let's consider this hypothetical department that they give us in the book. Complete coverage is going to require 600 labor hours per week. This need could be filled with 15 people. 15 times 40 is 600. So we could have 15 full-time people working 40 hours a week, and we'd cover our 600 labor hours. Or we could have 30 people and they could work 20 hours a week each. Or there could be any combination of full-time and part-time if it meets the 600 hours per week. Whatever combination is used, the staffing requirement in this example remains 15 FTEs. So 600 hours needed divided by 40 hours worked in the week. Make sense? All right, but 40 hours can't always be used to determine your FTEs. What must be used in the organization's official work week? So while this frequently is 40 hours, in some organizations it can be 37.5 or 35 hours a week. It is how many paid hours a full-time employee works in a week that defines the divisor used in determining FTEs. So again, that could be 40 hours a week, it could be 37.5, it could be 35, it could be 30. It's whatever that organization defines. So let's go down to the very last section. What then of positions that are covered more than 40 hours a week? Consider a medical surgical unit nursing position that is covered 24 hours a day, 7 days a week. To cover each shift for 7 days requires Monday through Friday coverage for 8 hours a day or 1 FTE because that's 40 hours, and 8 hours for each of Saturday and Sunday, but that's only 16 out of 40 hours. That's 0.4 FTE. So therefore, covering a single position for 7 days requires 1.4 FTEs, the 40 hours Monday through Friday, and then the 16 hours over the weekend. That's 1.4 FTEs. To cover that for all 3 shifts for 7 days is going to be 4.2 FTEs. All right, so moving over to staffing standards on 358. The determination of the number of FTEs required to staff a given function at a certain level of activity lies largely beyond the scope of this discussion. This determination requires a staffing standard. This is a number that reasonably relates required staff to the department's basic unit of output. It is sometimes expressed in terms of as a fixed component and a variable component, and sometimes in terms of a simple variable element alone. The fixed component covers labor requirements that do not change with normal activity fluctuations, such as a department supervisor, a secretarial support, or other fixed cost. The variable component fluctuates with activity volume. When a variable fixed figure is used alone as a standard, the so-called fixed elements of input are spread over all of the activity, rendering the single part standard somewhat less accurate. For example, the 2-part productivity standard for a hypothetical health information management department might appear as 22.8 hours per calendar day plus 1.764 hours per discharge, while a simple 1-part guideline might be 2.2 hours per discharge. So where do these standards come from? Productivity standards are arrived at through stopwatch time studies and predetermined motion times, which are time-consuming and relatively costly. Then you have work sampling, which is time-consuming and moderately costly. And then the use of published guidelines, benchmarks, or targets, which are generally provided by various external organizations. These kinds of indicators can be adequate, but sometimes they are unreliable because they are broad and do not account for legitimate differences in procedures from one organization to another. However, they are most commonly used of the 3 because they're economical. So you'll always hear when you have someone trying to set productivity standards, well, what are the benchmarks? What are AHIMA's benchmarks for inpatient coding? How many charts should you be able to code per hour? So those are where you get the benchmarks. They are easy to come up with, and like it says, it does not take into account differences in organization types. So sometimes you got to be careful of those. All right, so let's move over to the responsibilities in the budgeting process. The responsibility for preparing the total budget rests in part with several individuals and groups. The board of directors is ultimately responsible for everything in the budget and thus retains the authority for final approval. Now, they're not going to be involved with your budget. The budget's going to be done by the people within the organization, but they have the ultimate responsibility for that budget. Dropping down, The administrator or CEO must ensure that the budget being submitted to the board is consistent with the goals of the organization and is realistic and workable in the light of current knowledge of expected revenues and expenses. So they are the ones responsible for making sure it's acceptable and workable. The finance director has an active role in preparing the cash and revenue budgets and assembling all pieces of the operating budget into a total budget for the institution. Like the CEO, the finance director must ensure that the budgeting guidelines are followed and that the resulting plan appears to be workable and realistic. Then you have your supervisors and managers. So your supervisors and your department heads at least understand a participative budgeting approach, are responsible for assembling the expense and capital budgets for their own departments. In accounting or budgeting terms, the smallest organizational unit for which a budget is prepared is usually identified as a cost center. A cost center, which is an organizational unit for which costs are identified and collected, is usually provided with expense and capital budget prepared by the supervisor. In the case of middle or upper level managers who may have charge or may have charge of several cost centers, the task also includes assembling individual cost center budgets and a budget for the total area of responsibility. And our budget committee wasn't listed on the slide, but a budget committee may be established each year to facilitate the preparation of the budget. This committee usually consists of the CEO, the finance director, the director of nursing service, and other major department heads, and perhaps a member of the finance committee of the board of directors. All right, so let's talk about budget coordination meeting. Budgets run for a fiscal year, but there usually is some kind of kickoff to start putting that budget together. If the target for presentation to the board should be sometime in October, then the coordination meeting may take place in June or July. Convened and conducted by members of the budget committee, the coordination meeting should include all managers who have an active role in budget preparation. So in short, any known or suspected factor that may have a bearing on budget preparation is going to be reviewed during this time. So usually at North Mississippi Medical Center, you had to have your final budget submitted like the first week of June. So you got started, the end of April, and you worked on budget through May. And then by that first week of June, you had everything entered in. And beyond that point, there were no changes made. All right, so moving over let's go to page 360 under adoption. A summary of the total budget will be presented to the board of directors for discussion and approval. The summary generally includes the following: a narrative description of the budget and some of its key elements and the reasons behind its preparation in this manner, a condensed income statement for the budget period, a summary of capital expenditure request, a cash analysis covering the budget period, the key factors used in forecasting, and estimates of the impact of this budget on the institution's services and finances. And then dropping or going up to that next paragraph, finished is just begun. So a budget should be a live working plan. For it to serve in this capacity requires timely and accurate reporting of operating results. Reporting the results of the operations is generally a responsibility of the accounting department. Timeliness is essential. It stands to reason that the more recent the feedback received on results, the more valuable the budget is for highlighting the need for management action. The information received each month, a comparison of operating results for the periods with the budget projections for the period, allows you to make adjustments for those aspects of operations that are wholly or partly under direct supervisory control. And then you have an example of a budget report on page 361. But we're going to actually skip over to page 364, talking about control. So preparing a budget and working with it throughout the year heightens your awareness of how the department's resources, for which you're responsible, are used to fulfill the department's responsibilities. Reports of actual results versus budget projections provide all important information on which to base corrective action when needed. For instance, when productivity problems occur and the relationship between worked hours and the volume of work begins to change unfavorably, you can take positive steps that might include effective use of overtime, application of call time, scheduling of vacations and other time off, and routine scheduling of personnel for day-to-day coverage. All right, so let's talk about a little bit about cost control. The preceding couple of paragraphs described control as awareness plus action. It was noted that there are positive steps you can take when the relationship between worked hours and the volume of work changes unfavorably. It was suggested that you can manipulate the worked hours of employees so as to adjust personnel expenses relative to needs, applying more scheduled hours when work volume increases or fewer hours when work volume decreases. These actions are positive steps that can be taken to control cost, that is, to attempt to bring actual expenditures more in line with the anticipated cost reflected in the budget. Whenever you take such actions, you are engaged in cost control. Although it is always important to determine why budgeted expenditures or Although it is always important to determine why budgeted expenditures and actual experience differ from each other, cost control at the level of the first-line supervisor should consist of more than a monthly analysis of budget versus actual. There are, of course, many elements of cost within the healthcare organization over which the individual supervisor has no control. For example, unless you supervise a clinical function, there is little you can do about the cost of medical supplies or pharmaceuticals. Unless you supervise within dietary services, there is nothing you can do about food cost. Nevertheless, many elements of cost in a healthcare organization can be controlled or at least positively influenced through the actions of department supervisors. Why conscientious attention to cost control? Well, because every dollar spent by every department figures in the organization's cost structure and ultimately has some effect on the bottom line. All right, so dropping down to cost-saving opportunities for the first-line supervisor. It has already been suggested that the supervisor can affect personnel costs through adjustments in staffing and scheduling. Staffing is primarily the consideration of how many people of what skills may be required, but the staffing level, which may seem at times to be unvarying, can be adjusted through through schedule practices to meet specific needs as workload variations occur. Regarding staffing level, if there are variation in the department's workload, do you schedule people for peak activity to be sure all needs are covered? Or if this process finds you overstaffed for prolonged periods, do you staff for average workload expectations and assign extra hands during peak periods of activity? The former practice is easier but costlier because some employees are idle for prolonged periods. The latter practice, the least costly, often takes some creative juggling of people by the supervisor. Unless you supervise an activity for which the workload is absolutely constant or nearly so, it is consistently more economical to rely on variable staffing, which at times will require some creative scheduling. Often deceptively simple in concept, scheduling can be frustrating in practice because of the organization's policies, collective bargaining agreements, labor laws, benefit cost, personnel limitations in both number and specialties, and employees' desires and preferences. The person doing the scheduling, whether a supervisor or perhaps scheduling specialist, as is sometimes the case in large departments, is always constrained by the foregoing limitations. Also, all scheduling techniques are subject to two severe shortcomings. They cannot create personnel if such do not exist or are not available, and they cannot make people willingly work schedules that are undesirable or unacceptable to them. All right, moving down to control of overtime. Overtime has long been viewed in different ways by managers and healthcare organizations. Some supervisors consider a certain amount of overtime to be essential and recognize it as less costly than adding more staff for certain occasional needs, and others seem to view overtime as a form of reward for the department's better employees, and still others seem to regard overtime as an unnecessary expense to be avoided at all times. In most departments, some overtime may be at times necessary. Sometimes it's the best and most economical way to cover certain needs. However, is inherently costly and its use can easily get out of hand. So what are some of the most common causes of overtime? Well, variations in workload. If you have an increase in discharges, then your coding staff is going to get backlogged because they have more work than they're used to. And so you may want to pay some overtime to get that work caught up. Or absenteeism. If you have someone unexpectedly sick with the flu for a week, then you may pay your other coders overtime to get the work caught up. Or acceptance of substandard performance. So if you're not meeting those productivity standards, then you may have to work some overtime to get the work caught up as well. And then acceptance of overtime as a normal practice rather than an exception. So, they just automatically work overtime every week, whether the work is there or not. And then again, that kind of leads back to maybe there being some substandard performance. Then you have your bargaining unit work rules, or I skip one, rigid scheduling practices, inappropriate equipment or inefficient work area, or a lack of supervisor accountability. Now, how do you control overtime? Well, you regulate demand. You work on a reservation or appointment basis where feasible, and you spread out the arrival of work as uniformly as possible. Or you promote or publicize low demand periods. You can also utilize complementary scheduling, grouping certain kinds of activities into specific time periods. Generally, any steps that can be taken to move uniformly to more uniformly distribute the work over an available time will help avoid unexpected peaks and thus reduce the likelihood of overtime. Next, analyze and improve staffing practices. Cross-train your employees so they can kind of pitch in to cover for absent employees. Use float personnel if available. Next, analyze and improve work methods. Ineffective work methods, inadequate operating procedures, ineffective, obsolete, or inappropriate equipment, inefficient workplace layout all tend to depress productivity and thus increase the pressure for overtime. Next, control absenteeism. There's often a direct relationship between the department's level of absenteeism and the amount of overtime worked. One fact is certain concerning absenteeism. When the employees see the supervisor paying close attention to absenteeism, the rate of absenteeism tends to decrease. And then the last one, supervise responsibly. This is to consider oneself as accountable for the level of overtime usage in the department. Acceptance of this accountability suggests a thorough, rational approach to the examination of each instance of potential overtime. All right, so let's talk about a little bit about controlling workers' compensation. So workers' compensation, unemployment compensation, and short-term disability generally fall under the heading of statutory benefits, meaning that they are extended to all employees because they're mandated by law. Well, this is true for workers' comp and unemployment compensation, but short-term disability is only mandatory in 5 states and 1 territory. So let's move over to 368 and talk about workers' comp. So to have an effect on workers' compensation costs, the supervisor must exercise care in hiring. 2, remove substandard performers. Oh, I'm sorry, I skipped down to unemployment compensation. Let's go back up to workers' comp on the slides. So first one, ensure that employees are educated in the proper work practices such as safe lifting and safe handling of needles and other sharps, and that they recognize and acknowledge that the organization has an accident prevention program if it exists. So you want to make sure that they're properly educated in how to perform their job safely. Next, ensure that all safety rules are followed, those mandated by the government and required by insurance carriers, as well as your own rules. And then ensure that the required safety equipment is used as required. And if you feel that there is a questionable claim, challenge it. There are occasional instances of fraudulent workers' compensation claims, as some employees will claim that an injury occurred outside of work actually occurred on the job or on the employee's property. All right, now we're going to jump down to the unemployment compensation. So how you can control this: exercise care and thoroughness in hiring to reduce the chances of hiring an employee who may turn out to be unable to do the job. Some supervisors hire carelessly, especially for entry-level positions, apparently believing if this one doesn't work out, I can always get another one. 2. When hiring, and especially when applying disciplinary action, scrupulously follow all of the organization's policies and all essential legal processes, and always concerning orientation, training, disciplinary action, and efforts to improve unsatisfactory performance, create timely, honest, and accurate documentation. Next, in dealing with an employee who appears unable to meet the requirements of the job, unless there are compelling reasons to do otherwise, take action to remove them within their probationary period. So you really want to get them out early. And then work with Human Resources Department to challenge all unemployment claims that appear inappropriate. And lastly, when facing staffing needs of lesser duration than 6 months, consider temporarily hiring help instead of a normal hiring. So if you can get by with, a short-term PRN employee, or even using overtime for a few months instead of hiring a new person and having a whole new FTE, then try that. Last thing to cover is controlling cost. So supplies. How do we control supply cost? Supplies are a significant factor in some departments, for example, nursing and environmental services, but not nearly as much a factor in other departments, for example, finance and human resources. But every department has supply cost, at least on the order of those for finance and human resources, as miscellaneous items and office supplies that are consumed in the normal course of business. So here's some guidelines for the supervisor to consider. Assign specific responsibility to one person. This should be someone who is there most of the time, is aware of what is available and where it's kept, and knows the status of outstanding orders. Number 2, develop informal guidelines. Most supervisors need only informal rules based on experience, such as, for example, for item number AA, order 4 dozen whenever quantity on hand falls below 18. Or on the regularly weekly order, request 4 packs of legal pads when the last pack in the cabinet's been opened. 3. Make employees conscious of waste and its cost. Waste often exists and is sometimes encouraged because there seems to be an endless supply of everything they need. Lack of conscious attention to waste and its cost is manifested in lack of concern. Consider maintaining an inventory list on the door of each supply cabinet indicating cost and the reorder point for each item. Number 4, perform a periodic physical inventory, identifying items by name and quantity in stock. Number 5, monitor turnover of stock, determining the rates at which items are moving out, and use turnover information to refine the department's supply guidelines. Number 6, periodically clean out obsolete supplies, disposing of surplus or obsolete inventory through the organization's proper channels. The true causes of an unfavorable budget variance in the department's consumption of supplies could include any of the following: waste occurring during use, theft or pilferage, costlier products ordered and used than those called for, new procedures that render present supplies obsolete, changes in product specifications that render present supplies obsolete, improper product substitutions, and losses occurring during shortage and handling. So again, we did cover probably a little bit more of this chapter than I usually do in lectures, but again, be sure to read the entire chapter. I wouldn't necessarily recommend reading the for consideration unless you just want to. I would start, at introducing the budget and then go all the way through the end of the chapter, of course. But again, read your PowerPoint, listen to the lecture, and then read your chapter. That's going to build. You're going to get the basics through the PowerPoint. You're going to get a little extra listening to the lecture, and then you're going to go pick up all those fine details by reading the chapter. So happy reading, happy studying, and good luck on Chapter 21 test.